Bitcoin is closely following its 2019 surge, and prices could peak at roughly 45,000 in May. That's what our next guest says. Joining us to discuss is K33 Senior Analyst Vetle Lunde. Hi there, Vetle. Thanks so much for joining us.
Hi. Thank you so much for having me.
So just explain what you mean by that. What do you see? You're seeing similar patterns from the 2018 and 2019 bear market. What are the parallels here?
Yeah, so this is based on a very simple form of analysis, making fractals of previous drawdowns and also previous bottoms. And the current drawdown and recovery stage is remarkably similar to that of 2019, both in terms of duration and also in terms of price movements. But it's also a lot of similarities in other parts of the market. Structurally, derivatives are showing similar kinds of signals as those we would see back in 2019. And the entire sentiment feels eerily similar to that of 2019 as well. Just to contextualize the chart that we have in front of us here, it shows how Bitcoin has performed since the 21st of November after the FTX collapse, and it's compared to the bottom day of Bitcoin after the 2018 bear market. And the x-axis displays the amount of days, and it's pretty much dead on the same pattern, albeit the drawdown was a bit deeper in 2018.
Right, and that rally kind of ended with a big sell-off, but not just in Bitcoin, across all markets, with the COVID pandemic fears in March of 2020. I mean, hard to see that as a technical factor. It was obviously a major fundamental one. I mean, do you see the same thing happening? Is there a rally to a higher level and then a sharp sell-off?
Yeah, but the sell-off in 2019 was actually happening in the summer after a series of Donald Trump tweets where he had some negative insights on Bitcoin, and the entire market sentiment basically flipped on that day. Prices headed downwards. So the COVID crash happened 9 months later.
Right. So you're talking about an earlier correction there. So you see a similar thing. And you're also referring to the 23 rally and saying it has all the hallmarks of a hated rally. What do you mean by a hated rally?
So basically what we saw throughout the later part of 2022 was a lot of forced selling, and also selling from investors who grew cautious about where this would end. This has led people to be underexposed, and has also enticed a lot of people to short, being conservative with adding exposure at the current time. And this creates this dynamic where Bitcoin feeds on new short squeezes and moves higher, which has happened again and again in the past few months. And this is also well reflected in signals from derivatives, with funding rates remaining negative to neutral despite the strong price action. So it's a lot of clear telltale signals of investors maintaining underexposure. But whenever that flips, one should be cautious, because this market is currently restricted by relatively low liquidity, in particular in the aftermath of the credit market collapse in the last year. So prices tends to move respond quite swiftly to changes in demand, either on the selling or buying side. So the net buyer and the net seller has a huge impact on which direction the market takes.
Yeah, I mean, in some respect, our focus maybe last year, and for much of it, was on rates. We've had the macro story where the Fed was hiking, and that clearly played out across all crypto assets in a way that was seen to draw them to that risk on, risk on, off play. There were signs last week that inflation could be easing. Clearly still in a very restricted credit environment, but does that help going forward if in fact there are signs that the Fed is going to halt rates, or at some point even reverse them?
That would obviously help improve the market sentiment, but I think the Fed liquidity is the most important factor here. Whereas in terms of correlation and also the interest rate hikes that defined the last year, I think that's rather a story of the crypto market being extremely exposed to short-term interest rate hikes due to how investors and also how the crypto companies responded during the zero interest rate period. it was a lot of spending, a lot of focus on growth, few focused on building sound businesses. So you had this environment where miners took a lot of fiat debt and held a lot of Bitcoin and then were exposed to falling prices. In addition to all the crypto banks starting to neglect due diligence to offer loans to, for instance, 3 Arrows Capital. And all of a sudden, when prices started to fall, the entire market structure quickly deteriorated. And that was due to very bad risk management on the backdrop of low interest rates. Whereas now, a lot of these rotten fruits have been washed out of the market. So the entire market is in a more robust stage right now where it can handle higher interest rates for longer. But it would obviously react positively to a changing dynamic there. But I don't think interest rates are as relevant anymore as they used to be.
I mean, do you think that the industry as a whole has kind of learned its lesson here? I mean, is there a more disciplined approach to, risk management to, and also applying that free money to, effective constructive building?
I think the industry has a short-term memory. So for now, I think the industry has learned, but I'm pretty sure that we will experience similar kinds of crises in the future, unfortunately. But for now, those kinds of risks feels washed out of the market, so the market feels a lot more safe at the moment.
So what's your take on ETH? Our previous guest was talking about the success of the Shapella upgrade, and Coinbase analysts, others talking about how it has been supportive of the price. What's your take on ETH's outlook from here?
Yeah, so in the short term, the reaction from ETH after Shapella was a typical example of the market overreacting to news. So Ethereum has reclaimed 0.07 versus BTC, which is the average price of ETH BTC over the past 2 years. So it's more or less dead on where we should expect ETH BTC to be. And it's a very fair price, in my opinion. But the market overestimated a bit how much selling pressure would come from allowing stakers to unstake. And for instance, with the Kraken unstaking, this was forced upon Kraken by the Wells notice they received from the SEC, and users of Kraken who sought to stake Ethereum had already a long-term view on Ethereum and wanted to hold Ethereum for the long term, thus locking it in to secure a yield on it as well. And these investors are not inclined to sell. And additionally, partial withdrawals may be bundled together to validate, to grow further in validating. And to add some context to Christine's points on institutional activity in ETH, I came across a very interesting discovery just before this call, that the open interest on CME in ETH is up 43% over the past week. So, and that's in notional terms, so not in dollar terms. The price appreciation hasn't elevated that number, but the open interest is very high at the moment, and it seems to be at least a growing speculative demand for Ethereum among institutional traders at the moment.
Yeah, I suppose they can get exposure via those derivatives markets to start with, and then sort of test the water a bit. Okay, well, thank you very much, K33 Senior Analyst Vetle Lunde. Thank you so much.